Thank you for listening to What Your Money Would Say. I'm here with David Bach, who is actually one of the first financial authors that inspired me to get into the financial industry when I read his book when I was only 14 and a half. But David Bach is one of the most trusted financial experts and best-selling financial authors of our time. He's written 10 consecutive New York Times bestsellers with over 7 million copies in print. He's impacted millions of people, including me, over the past 2 decades with seminars, podcasts, thousands of media appearances. He is the co-founder of one of America's fastest-growing RIAs, Registered Investment Advisors, AE Wealth Management, and he's also the founder of Finish Rich Media, a website dedicated to helping us learn about money in a revolutionary way. David, great to be back with you.
It's my pleasure. It's always great to be with you. And boy, it's been an interesting summer. So I know we're going to have a lot to talk about as we discuss the economy and things that many people are both concerned about and maybe, somewhat curious as to what's going on.
Wall Street has taken a beating lately in recent weeks. What's going on?
So August was it's been a volatile summer, but August was really volatile. We saw a lot of movement in the market, both up and down, and 200, 300, 500, 600. I think at one point there was an 800-point swing. That's not comfortable. It's not fun. It's not fun to watch. And so one thing I would tell you, if you're watching the market closely, and you don't need to, you don't. Really, like, my best advice to you, especially if you're in retirement, but if you're approaching retirement, is we actually know that the less you look at your accounts on a regular basis when the markets get volatile, the better off you'll do, because you won't make any rash decisions. You also won't drive yourself crazy. So there's a brand new data just came out from Fidelity. They showed that they have more millionaires today in their 401k plan than ever before, 196,000 401k millionaires. So there's a lot of good news out there. And of course, we can get to the bad news. But there's been part of why we're going into volatility right now is because we're coming off such a strong economic expansion.
David, what's the bad news of all of this happening as of late?
Well, the bad news is everybody knows we're coming off 10 years of an economic expansion. The reason this is bad news is that, quite frankly, it's been a very strange economic expansion the last 2 or 3 years because people have been so fearful of the next recession that we've basically climbed what I would call a wall of worry, where the markets keep going higher and the consumer keeps spending and the news continues to be positive, and yet we continue to worry about the next great recession. Sometimes, by the way, that worry actually leads to a recession. So what's happened as I would say, the world starts to worry about a recession is that things are slowing down. Like, I was looking at global data. There are 9 major countries right now on the verge of a recession. And part of what that's leading to is what's called an inverted yield curve. And that's a very technical term. If you weren't an economic, maybe major in college, you have no idea what an inverted yield curve is. But, what an inverted yield curve is that investors get scared. And so they decide that they would rather have their money in as safe of an investment as possible. And that's a long-term government bond. And so in a weird way, what's happening is that people are rushing to buy what they consider to be the safest investment possible, which is a U.S. government bond and a long bond, like a 30-year bond. And what that's doing is it's actually lowering the rate of those bonds so that the rate on these long-term bonds becomes less than the rates on a short-term bond. And that's what inversion means, because usually what happens is if you would buy, like, simply put it, let's say normally you would buy a 5-year bond and it would pay 2%. If you were willing to tie up your money for 30 years, well, then the 30-year bond might pay 4 or 5%. You wouldn't put your money in a 30-year bond to earn less than what you could earn in a short-term bond. That's an inverted yield curve. And that doesn't happen very often, like very rarely does it happen. And when it does happen in the past, people who study all this stuff will tell you that it is an indicator, like a leading indicator for the fact that a recession is coming. That when the bond market inverts like that, when institutional investors get spooked globally, when people rush to safety of long-term investments, it's a sign that the economy is slowing down. And the bond markets tend to be the precursor to a downturn in the economy. And then ultimately what people fear the most is then also a downturn in the stock market. So that's what the inverted yield curve is. That's got a lot of attention. And by the way, that can go back the other direction too. Inverted yield curves aren't a permanent thing because they're based on the market. So, the question becomes, what's creating this inverted yield curve? Why are people so worried about a recession? And what's the boogeyman out there? And truly, I think the major boogeyman that is out there is the Trump trade war with China. And I just got done touring across America for the first half of the year. I put out a brand new book, The Latte Factor. I toured all across the country with our great financial advisors and got in front of our clients. And I said, the economy is doing fantastic. The biggest thing we have to worry about is this trade war with China. And I said, I hopefully we all hope this trade war will get figured out, because that song we used to listen to, War, what is it good for? Nothing. And then I would make the audience say it again.
Now, David, how long do recessions typically last?
Here's what's really interesting about recessions, because we worry about them so much. The average length of a recession has been 10 months. It's not that long. The last major recession we went through, the one that everybody remembers like it was yesterday, was 18 months. So recessions aren't as long as people expect them to be. And again, when you think about a recession, recessions don't always mean that the stock market's going to drop and your investments are going to drop in half. And the last thing I would say, to take a breath here, is that when the markets go down, they recover very quickly. Like the average market downturn that is over 10% has recovered on average in over 107 days. Now, sometimes a little bit longer and sometimes a little bit shorter, but markets recover pretty quickly. So the real key is, if we start to see things get crazy again, it's to not act suddenly, because timing the market truly doesn't work. It's the fastest way to destroy your family's personal economy. And that's the one that matters.
Whether we're in a recession or appear to be heading toward one, what should we be doing with our retirement savings and investments?
Yeah, so I always like to make this a way that people can relate to it. I think you have to run an emergency boat drill. And let me explain to you what that means. If you've ever been on a cruise, what they make you do before they take the boat and they leave the actual dock, the pier, they make everybody go on a drill, on the emergency boat drill, where you have to know where the emergency boats are, right? Like they actually go through, like, here's where the life vest is, here's where you're supposed to meet. So God forbid this cruise boat goes down, you know how to be safe. So here's what I mean by this. Here's how you run what I call your emergency boat drill for yourself and your family. You need to have a real retirement plan. Hope is not a retirement strategy. So here's what should be in that plan. Number one, you should be able to answer the question today: how many years of income do you have protected, so that if the markets go down, it doesn't actually matter? You're not coming home and telling your wife you can't go out to dinner tonight because there's a trade war in China and the markets are down. You've got a retirement plan where you've dialed in an income stream. Ideally, it's a protected income stream. So you've got a guaranteed level of protected income coming in. Is there anything we can do to rebalance or protect our portfolio at this time? Can we create some protected income? Now is really the time to be meeting with your financial advisor. Now, most people, by the time they've retired, if they have real assets, they're working with a financial advisor. But first person to call your financial advisor. Go have a meeting. Pull back out that financial plan that maybe you did 2 or 3 or 4 or 5 years ago. Review it all over again. You probably forgot what's in half of it. If you're listening to this and you don't have a financial advisor, go get one. Go meet with somebody, not just somebody. Meet with somebody who's qualified, who's really good at, who's a retirement planning specialist, and have them run a real diagnostic of what you currently own and show you how much risk you're taking. Check and see if you've got too much money in stocks. The reason people get so hurt when the markets go down typically is that because they're invested too aggressively. And that often happens at the end of a bull market. When you have a 10-year economic expansion, there's a whole lot of investors that have got way too much risk now in their portfolio that they don't need to be taking. They already won the game. Now's the time to enjoy it. And, as I've gone around the country, I've been really talking to people about pulling back on their risk level.
Why is playing to our emotions in making investment decisions really a dangerous road?
Such a good question. Well, first of all, we are emotional human beings, right? Like, we're not robots. So I think one of the things that's important to say, whether you're in your 30s, your 40s, your 50s, your 60s, your 70s, your 80s, people always talk about how your investments should be based on your age. You should be more aggressive when you're young, and when you get older, you should be more conservative. So my advice to you, it hasn't changed. I've been doing this since 1993. Work with a financial advisor. Build a rock solid, boring portfolio. Your investments should be boring. Your retirement should be exciting. Your investment should be boring. Your life should be interesting. So go meet with a financial advisor, build that diversified portfolio. When the markets go down and you're still investing in like a 401k plan, then that's good. No, you're buying the markets on sale, and that's a good thing. And just stay at it. Long-term investing success takes place in decades, not in days. The way you hurt yourself is getting emotional on a bad day. So if the news is terrible and the markets are down, don't go look at your account today. Don't look at your account over the weekend. When the markets go down on a Friday, you can drive yourself crazy over the 2-day weekend and then rush to make decisions on a Monday. It's almost always the worst thing you could possibly do. Stay the course, meet with your financial advisor, and just take a deep breath.
Thanks, David, for joining us on What Your Money Would Say. We really appreciate you stopping by.
My pleasure. Have a great day.
David Bach is a co-founder of AE Wealth Management. Mr. Bach may financially benefit from an advisor's use of this presentation. Bach is not affiliated with and does not endorse the firm and/or advisor hosting this show.
Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and SWAN Capital are not affiliated entities. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. SWAN Capital is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the United States government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by SWAN Capital.